Good day. This is the second in a six-part series on the cost of capital, and this section deals specifically with the cost of debt. When we look at debt of a company, the price of the debt is determined firstly by the quotation of the financier, the price that they require the company to pay, and that is determined by their yield to maturity that they require. The second one is the calculation of the internal rate of return of the cash flows. So the company itself calculates the cash flows that's involved in the project and the cost of the cash flows, as well as the cost of the money, and determining an internal rate of return, and we'll discuss the internal rate of return later on. But that is then the price to the company. And the last element that needs to be considered is the fact that these numbers are estimations. We are not certain what's going to happen in the future, and therefore the best possible estimation of these numbers should be made given the available information on market conditions and expectations in the market forward, so that correct decisions can be taken on the financing. Second, another element that's important in the consideration of the cost of debt is the impact of taxation. When we look at a statement of comprehensive income, the high-level structure is basically sales. This cost of sales gives us gross profit minus expenses gives us net profit before interest and tax. And then you'll see we are deducting interest before we calculating tax. It means that we are paying the interest with pre-tax money. Before we're paying tax, we're paying the interest. And therefore it's got a positive impact on the actual cost of the debt and the interest that we pay. Looking at the formula, we can see that the cost of the debt is taking the 12%, which is quoted by the financier, and we deducting the 28%. In South Africa, the 28% is the company's tax rate. We're deducting 28% off the 12%, and that leaves us with a 8.64%. It's important that we see it is not 12 minus 28, which gives us minus 16. No, that's not the way to do this. We're taking the tax portion, we're taking 28% off 12%. So it is 12% times 28%, and that is then about 3.36%. And if we take that off the 12%, then we're left with the 8.64, which is the effective rate that the company is paying after the impact of tax. Two broad types of debt. The first one is irredeemable debt. In other words, it's perpetual debt. It continues, and there is no set date for settling the specific debt. But we need to pay the interest or the coupon rate on a regular basis, either quarterly, semi-annually, annually, depending on what the contract states. And the way to calculate the cost of irredeemable debt is taking the interest, and in our example here, the interest rate is 15%. So it's 15% of the or the par value of the bond of 100 Rand. So that is 15 Rand that we're paying as an interest, and we divide that by the current market price of the debt instrument, and let's say that is 90 Rand. That gives us a 16.67% as the cost of the irredeemable debt. The second form of debt, and that's the one that's most often used by companies, there are redeemable debt instruments. And these are specifically structured that you've got a start date, you've got an end date, and during that period you have regular payments. In bonds it's called coupon payments. So in the example here, and in this one we work with pre-tax, so it is before we deduct the tax off the installments or the interest installments. So in year 0, in other words present value, we assume, similar to our previous example, the market value of the debt instrument is 90 Rand. Then we are making regular payments every year at 15%. So that is an outflow, it's a negative number, it's an outflow of 15 Rand per year. And in year 10, we still make that 15 Rand payment because we issued the debt instrument, but we also paying the capital amount of 100 Rand. So although the market value currently is 90 Rand, that is what it's trading in the market for, the par value is 100 Rand at the end of the period, and that is what needs to be repaid, plus the final interest for the 10th year. And that's why we have a outflow of 115 Rand in year 10. And if we then calculate the pre-tax internal rate of return, we get 17.16%. But it's important that we understand this is pre-tax. And as we said earlier, in most cases, the post-tax impact is required. So the next example is a repeat of the previous one. It's just a post-tax example. So we still market value at 90 Rand, but now our installment, our payment, annual payment is after tax. So it's the 100 Rand at 15%. That's the coupon payment. So it's 15 Rand. And we're taking off the tax there, and that leaves us with a 10 Rand 80 obligation on an annual basis. In year 10, we repay the capital amount of 100 Rand plus the final year's payment, coupon payment. And now you can see the internal rate of return is 12.62, which makes our debt cheaper. And because our debt is cheaper, our benchmark on successful or acceptable projects is therefore lower, and therefore we can accept projects at an internal rate of return exceeding 12.62%. Corporate debt has an important impact, and the first thing is the flotation costs. And flotation costs is the cost of issuing the debt. The cost of issuing the debt is normally where you've got a merchant bank involved or any of the financial institutions that assist the company to issue the bond. And therefore, in this example, you'll see that we've got we're issuing the bond or the debt instrument at 1,500 Rand per unit. But there's a 250 Rand flotation cost, which means there's a fee that the merchant bank charges us to assist us to issue this to the market. So the net proceeds that we receive is 1,250 Rand. So we cannot use the 1,500 Rand because we're not receiving that money. We're receiving 1,500 minus the 250, and that leaves us with 1,250 in as an inflow when we issue these instruments. Our annual payments, however, is on the par value, and that's on the 1,500. So we are paying 10% on the 1,500. This is again a pre-tax calculation. And in the final year, we are repaying the 1,500 because that's the paper that the investor has in his hand, and we need to repay the 1,500. plus the last cash flow of 150 Rand, and that gives us an internal rate of return of 13.8%. So it's important that we understand that there is a flotation cost. There could also be a premium, in the sense that if we issue it for a higher price than the current market price, then we receive more than what the par value is. That brings us to the end of the second session on the cost of capital, and in the next one we will then look at the cost of preference.